And our first guest this morning, Bill Baruch, joins us. The president of Blue Line Futures is with us to break it down. Bill, welcome back. I want to first, talk commodities, but first some of the selling we've seen in the indices. Rates and inflation's concerns spiked again this week. Now that we've taken out the lows from last week in the ES, am I correct to have my eyes on the June low, that 36.39 level is the next big area for the bears to be watching?
You know, that's the easy part to look at. That's where this thing could really go. That's the next big level. But if there's a couple of things also that we're looking at here. I was on with Oliver Rednick earlier this week on, I think it was Tuesday, and pointed out that on CPI day, if you go back to when the May report was released in June, on that CPI day, if you count 5 days, including that day, or just 4 days from that day, it took the stock market S&P to bottom out. So if we take this Tuesday, the same number of days takes us to Monday. So, you know, we get this selling. I'm really welcoming some selling. The next big level of support that we see is about 38.10. There's a couple levels that align there, including the May low. So the interesting thing about it being Monday is this, as the same number of days and get this flush out, is it takes us through quad witching. And after quad witching the Monday after quad witching has been a pretty tremendous, just a really monumental low, throughout history. I mean, just in recent history too. Looking back in December 2018, everybody was talking about Mnuchin speaking to the banks. It was actually the Monday after quad witching. You look back at March 2020 was the Monday after quad witching. And then, there's people can say, okay, well, the Fed was easing then, they're tightening now. Well, March of this year, they certainly weren't easing. And certainly of June of this year, they weren't easing. And we saw bottoms, significant bottoms and rallies around that March quad witching, maybe not the Monday after, but it came right around it, as well as June. So, the other part of this too is we're starting to see these expectations for the Fed hawkishness to continue to really mount. Now, I'm not as, I look at it as where the risks skewed. And we put out a note earlier in the week saying risks were skewed to the downside, given the way the market was elevated. Now the risks can be skewed to the upside at next week's Fed meeting if we are lower. And those expectations for Fed hikes continue to mount. We're seeing 200 basis points worth of hikes with more than a 50% probability coming in for this meeting next week. So is it getting a little overboard? Maybe. And maybe the Fed tells us the world isn't ending. And the real thing is, I think they're eyeing too the rinse, which the rinse in the first half, maybe as early as the first quarter of next year, which is 33% of the CPI number, will start to come in. These are lagging significantly. So I think given this commodity crush, I think commodities can trade lower. Stocks, potentially, obviously down to 3,800 a minimum here, and we could start to see this inflation narrative continue to deflate a bit right when rents start to come in, at the early part of next year.
Okay, now to that point here, and I'd agree, maybe it's a little bit early to start pulling out the Chicken Little costume out of the closet and start running around screaming and yelling about how the sky's falling, because while we have taken out last week's lows, if we just pull this chart, you were just talking again about the May low, basically, which holds for the most part right around this 3,800 level. So we're still above that as well. Again, taking out last week's lows. I'm more dialed in on the June low, 36.39, but I did notice here, and to your point, if we, and potentially reverse head and shoulders here, I'm kind of looking at if we were to find some support at this lower level here right now and start to rally back. Now, again, if we continue lower, it's more in line with the trend we've seen off the Jan highs and more kind of supportive of the bear market, and kind of what we've seen. But going back to energies here a little bit, because this is a big part of this discussion. I mean, you've got the ES lower, which favors into a higher dollar, right? Rates also, TNX, TYX, as I pointed out in the show, on the move higher this week. But the dollar higher also tied to the EU struggles with energies into the fall and winter, the crisis they're they're trying to avoid, potentially facing here still. The short of it is, with WTI and natural gas at current levels, I guess, is it raising the likelihood of a EU recession? One could argue energies at elevated levels at that point are kind of bolstering the U.S. dollar. This week to crude, $90 again. I mean, it's spending more time around this $90 level than it has around 80, it seems like.
Yeah, speaking of inverse head and shoulders, I mean, crude, if it can hold around $85, we could see an inverse head and shoulders start to build there. This is just another lower high, though, in crude. And we put out in our notes, rarely put out major four-star supports. We had a rare major four-star support, a wide range today, this week, 89.50 to 90.50, roughly what it was. And it went right up into that, failed there. So this is another pretty monumental failure in crude. Now, you know me, I've been extremely bullish crude for a while. going back to June 2020 at time. And I think crude really needs to flush. Maybe that means $75. Maybe that means maybe just poking its head below 80. There's too many traders, retail, and even, I mean, I think the liquidity is low because some of the institutions have stepped away a bit because of the volatility, and they kind of feel that there needs to be a flush too. But a lot of people have been ingrained that they need to just, they buy the dip, they buy the dip, they buy the dip, and it pays off. So I don't know here in crude. I mean, personally, I like energy stocks a lot. I think I think you need to continue to be overweight energy stocks, and but that's with a longer focus. I still like energy. The other thing is natural gas. You had this big spike in natural gas that came on Wednesday when everybody's worried about the rails and the rail strike, and then natural gas gave it all back up yesterday because they're not going to be able to move coal on the rails, and so the higher demand for natural gas, which in turn questions: are we going to, if that were to happen, will we question will we export natural gas as much that was planned? So that just shows you how tight the narrative is with Europeans' energy crisis. So I think it's a fluid situation right now. I think we're looking at the dollar, and I think that's the most important thing right now. Does the dollar break out really above 110.50, 110.75, and start to run? And that gets us the potential commodity crush that the Fed's really asking for. Maybe the stock market crush that the Fed's asking for too. And if we can see that in the next couple of days, I mean, the risks are certainly going to be skewed to the upside, and then we have a very seasonally bullish time of year in equities and through the midterms. And there's something like I don't know, maybe 100% batting average over the last 20 midterm elections, where from a year from that point, the stock market's higher. And so I think there's reason not to be extremely negative here right now, and use this. If you're patient, there's going to be a lot of opportunity ahead.
Okay, I like that also in terms of the bigger picture kind of discussion here, and not just getting kind of tunnel focused and forward focused only on the inflation. But talk to me in terms of sticking with this discussion on a bigger picture, copper right now, because it has started to roll over again. It had dipped back down to 320 just below, rallied back up to around 380, but now it's starting to show signs, maybe a little bit of more weakness to come.
Yeah, Dr. Copper sort of, gave us a bit, of that rollover. I mean, as all markets did on after that CPI number was pretty hot, and it's just more of a shallow high. And so I think China's been struggling. China consumes over 50% of the world's copper, I believe, and their data last night wasn't bad.
Yeah, industrial production number was
Yeah, I think across the board, everything just kind of nudged out those expectations, and that's a positive sign. I think are they turning a corner? So I think there's a lot of questions there. I mean, personally, one of my larger focuses has been a short metals position. Short gold. Silver's spike gave us a really pretty great opportunity on Monday. Platinum has been really sticky. I mean, it's kind of down today, so I'm rolling some stops down there. I think that could be something that goes lower. And copper. I mean, I just think that was a major focus of ours, given the currency dynamic, given some of the trends. I mean, the fact that gold never followed the other metals at all when they traded higher was, I think, a sort of a canary in the coal mine there. Mm-hmm. And the flush in gold here is really needed. So I think in the metals, I'm welcoming, and same thing as talking about with equities here, is I'm welcoming a flush. I think there's a lot of opportunity ahead if we can get that.